Today we're going to talk about Alibaba, as the stock has fallen almost 13% in the last 10 days. And more specifically, I want to talk about China's announcement around their GDP growth. They came through with growth of 4.6% year over year in the third quarter. This slightly beat analyst expectations, but that isn't just a good thing. That could also be a bad thing for China moving forward. So in today's video, we will discuss all of that and more. So if you enjoy the video, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. Before we jump into all of that, let's take a look at the YouTube portfolio. The current value of the portfolio is sitting at $54,421.10. And I haven't changed anything around the positions that I hold. I have Alibaba, Apple, Microsoft, Palantir, PayPal, SoFi, Visa, as well as a couple dividend ETFs with SCHD and VYM. Again, as a reminder, I plan to at some point in the future sell out of one of these two ETFs. Right now, just holding on to them as they're gaining pretty decently over the last couple of months. So obviously the position that we're focusing the most on in this video is Alibaba. I currently have 15 shares in this portfolio, but this is just my YouTube portfolio. I have a much bigger portfolio separately that I hold the majority of my Alibaba position in. And right now we've seen a gain of about 32, almost 33% on this position. And overall, Alibaba's had a great year. That's why we're seeing these gains on the position. The stock right now year to date is up 37%. However, in just the last month, we've seen it fall about 13%. And in my opinion, a lot of this pullback in the stock is probably from people taking profit in their positions. I do think that there's a little bit of concern in this GDP announcement that we're going to get into. However, there's probably even more people just taking profit, getting out of Alibaba potentially completely, because we've seen over the last couple of years, the stock do this kind of fake out where it goes up to $100 to $120. And then all of a sudden the stock sinks all the way back down into the $60 to even $70 range. And the most severe example of this is actually almost exactly 2 years ago. Back in October of 2022, Alibaba's stock price was sitting around $65 per share. And over the course of just a couple of months, the stock ran all the way up to $120 per share, doubling in price. However, in again, just a couple of weeks, the stock fell down to around $80 per share, kind of sat in a range there, bouncing between 80 and 100 before falling all the way back down into the $70 range. The second thing that could actually extend this sell-off that we're seeing in Alibaba is the recent announcement around China's GDP numbers. They came through with growth in the third quarter year over year of 4.6%, which actually slightly beat analyst expectations. When you first read this headline, you're probably thinking this sounds like a really good thing for Alibaba in China. However, when you think about it a little bit deeper, you start to see some potential cracks. They came through with growth in terms of their GDP of 4.6% year over year, slightly exceeding expectations of 4.5%. This is where things get a little interesting, because if China is looking at this data and they're saying that they're actually beating their expectations, is there really still a need for stimulus? And that's where we could see some problems. If they start shutting down some of these stimulus programs because the economy is growing faster than they actually expected, that could have a negative effect on Alibaba as well as the whole of China. And honestly, these GDP numbers are basically on track with exactly what you would expect. If you take out this time period from 2020 really through till 2024, China was decreasing their GDP growth from around 7% in 2014 down to around 5.8% in 2019. We obviously had the pandemic happen, things went all over the place for a couple of years, but here in 2024, they got back to around 5.3% growth in the first quarter, and then they've seen slight declines just like before in the more recent quarters, down to 4.6 in again the most recent quarter of 2024. So when you look at those numbers out of China, it really makes you question whether there's a need for stimulus. If you trended the numbers from 2019 till 2024, they're about where you'd expect growth to be at. And when you compare those numbers to the US, it gets even worse because China's growing at a faster rate than the US. Right now, the US is only growing around 3% year over year. They did go through a pocket of growth in 2020 and 2021 of higher growth rates. However, they've settled out more to their average of around 3 to 3.5% growth year over year. Personally, if I were concerned about the Chinese economy, I would look to sell out of my position. However, I believe that the Chinese economy has hit a low and it's turning around, and I do think that China will continue with their stimulus. Part of the reason I believe that is because their target for GDP growth is actually 5%. So they're still a little bit off of that target, and I think that China will use stimulus to try and get back there. We've even seen some economists come through and talk about how the full year target of growth is around 5%, and that is now within reach with extra stimulus in the fourth quarter. So yes, there is potential downside to these numbers being released because the Chinese government could see them and potentially pull back on some of their stimulus, but for me personally, I think it could actually motivate them to do the opposite and maybe double down to hit their target or even beat their target to show the world that they're back on track and that China is a growth economy again. And China has a little bit of a secret weapon that a lot of people don't really talk about. Their savings rate within the country is 46% as of 2022. They hit a low back in 2019 of around 43.7%. That's because a lot of things were going right for the country. And as we've seen the economy deteriorate over the last couple of years, as well as some of the restrictions within the country, the savings rate has started to increase. However, if they can get back on track of getting more people comfortable spending money in China, that could actually lead to a lowering of the savings rate and start boosting up their economy and propelling their GDP growth even further. And to put that savings rate in perspective, the current US gross domestic savings rate is sitting at 18.11% as of 2022. So clearly there is a big gap between the US and China in terms of savings rate. And if China were to get down to even 30% or 35%, we would see a lot of additional money out in the economy within the country. And that would just mean more people spending more money at companies like Alibaba within China. Overall, that's going to be a good thing for companies and the economy in general. That's why we have heard so many people talk about US consumers and the resilience of the US consumers, because they're not afraid to spend money. In China, it appears to be a little bit of a different story, where there is a little bit of fear around what the future holds, and thus people are not as willing to spend money. And this confidence or lack thereof confidence from the Chinese consumer does create a little bit of a drawdown in terms of the valuation of Chinese companies. Right now, Alibaba's forward P ratio is sitting at an 11.72, and this is over half that of the S&P 500. The S&P 500 currently has a forward P ratio of 24.15. So I think overall that Alibaba and the Chinese economy will get headed back in the right direction. Otherwise, I wouldn't have shares of it in my portfolio. I think that China recognizes the issues that they're seeing, and they'll make adjustments accordingly to get the economy and a lot of their companies back on track. And honestly, if the stock were to fall all the way back to $60 to $70 per share, I'd probably look to add more to my positions. But as I always say, never buy a company just because some random guy on YouTube talked about it. Make sure you are doing your own research and looking into companies that meet your risk tolerance as well as your time horizon. With all of that said, I hope you enjoyed the video. If you did, drop a like down below. And if you want to see more videos like this one, make sure to subscribe. And as always, guys, have a wonderful rest of your day. And for the joke of the day, how do you mend a broken gourd? Check the comments down below for the answer. Thanks for watching.